Welcome to our CFP exam prep discussion on alternative minimum tax, or AMT. Let's dive deep into this complex tax concept that frequently appears on the exam and often challenges candidates. The alternative minimum tax serves as a parallel tax system designed to ensure that high income taxpayers pay at least a minimum amount of tax, regardless of their deductions or credits. Think of AMT as a safety net that prevents excessive tax avoidance through legal deductions and preferences. Understanding the mechanics of AMT calculation is crucial for the exam. Start with regular taxable income, then add back certain adjustments and preference items. These additions include state and local tax deductions, private activity bond interest, and certain miscellaneous itemized deductions. For example, if a taxpayer has regular taxable income of $200,000 and $30,000 in state tax deductions, this amount would be added back when calculating AMT income. A common mistake candidates make is confusing regular tax preferences with AMT preferences. The AMT system has its own set of rules. While regular tax might allow full deduction of property taxes, AMT requires these to be added back. Another frequent error is forgetting that AMT has its own exemption amounts, which phase out at higher income levels. The calculation process follows specific steps. First, calculate regular taxable income. Then, add back AMT adjustments and preferences to arrive at alternative minimum taxable income. Next, subtract the AMT exemption amount. Finally, apply the AMT tax rates, which are 26% on the first $206,100 and 28% on amounts above that for 2021. Let's break down a typical exam scenario. A taxpayer has regular taxable income of $300,000, state tax deductions of $25,000, and private activity bond interest of $15,000. For AMT purposes, both the state tax deductions and private activity bond interest must be added back, potentially triggering AMT liability if the resulting tax exceeds their regular tax liability. Watch out for questions involving incentive stock options. The spread between the exercise price and fair market value becomes a preference item for AMT purposes, though it's not taxable for regular tax purposes. This catches many candidates off guard. One critical concept to grasp is that taxpayers pay the higher of their regular tax or AMT. The exam often tests this understanding through scenarios where candidates must determine which tax applies. Remember that AMT credit can be carried forward to future years when regular tax exceeds AMT, but only for certain deferral preferences. For exam preparation, focus on recognizing AMT trigger items. These include high state and local taxes, numerous dependent exemptions, large miscellaneous itemized deductions, and significant long-term capital gains. The exam commonly presents scenarios where these items combine to create AMT liability. A practical approach to AMT questions involves first identifying whether the taxpayer has significant preference items or adjustments. Then, determine if these items are large enough relative to income to potentially trigger AMT. Finally, calculate both regular tax and AMT to determine which applies. Remember that recent tax law changes have reduced the impact of AMT for many taxpayers, but understanding its mechanics remains crucial for the CFP exam. Focus on the fundamental concept that AMT exists to ensure a minimum tax payment and master the basic adjustments and preferences that drive AMT calculations.